All right, so these two gentlemen, Pete Larsen here, and then also Fareed, they're working with a company called MW Law. So MW Law is a boutique powerhouse firm focused on M&A, corporate structuring, and real estate private equity. The firm combines legal expertise in mergers and acquisitions, commercial real estate, private security, syndication and funds, and corporate law, with Stewart title affiliation as a one-stop shop for M&A and real estate investment deals. They pride themselves on an impressive track record of structuring over $2 billion in transactions annually across a diverse array of assets. We just want to say thank you so much for joining us today at the Acquisition IQ National Tour. And let's talk a little bit about business acquisitions. Okay, that's one thing we'll touch on, and then also we'll talk about the real estate that's associated within a transaction and how important that is. So let's start with you, Fareed. I'm a business owner and I'm looking to make an acquisition. What's the first thing I need to do?
I think the first thing you want to do is understand what you're getting into, understanding the business, how it operates. How it operates now, how you're going to operate it, and then probably some details from there is like what's your capital stack going to look like, and then what's your plan for doing the acquisition. Are you going to work with brokers? Or are you going to kind of go by yourself and just reach out to a bunch of different business owners to try to find an acquisition that way, and then doing the quality of earnings or yourself or through a third party. And then going through the M&A process, where typically where we come in with purchase agreements and ancillary documents.
So share with me, Pete, some of your experiences obviously going through transactions. I'd like to have a little bit of a conversation here. We will open up the floor as well for Q&A just to make sure you guys are addressed. But share with us a little bit about your experience from both the law side as well as one who's about to make an acquisition.
Yeah, so most of my career was in-house. I used to be the general counsel of a Wall Street company that did financial services for, I don't know, if you think about the top 15 investment bankers and the top 20 private equity groups in New York, they were our clients. And we did everything from underwriting to evaluation to asset management to servicing and special servicing of loans. And that's kind of the space I was in. And in that space, we bought, while I was there, we were sold 3 times. And we bought, I don't know, at least a dozen companies in both the US and Europe. And so I just got a lot of experience in that kind of space. But I've always been attached to real estate. And even in that role, most of those private private banks and private equity were doing, real estate transactions, and that's what we were really about. So I've always kind of been attached to real estate. I was the general counsel of that company when we had the contract with the FDIC when they were closing down hundreds of banks. So I special serviced the worst loans you could ever imagine coming out of failed banks. Just ridiculous, the kinds of things that banks were giving money to back then. And so you learn a lot when you go through distress situations. So I kind of think that helps me in the finance side, just kind of understanding how bad that deal.
Let's talk about restructuring. You guys know what restructuring is, right, of a company. And I know you've had extensive experience on restructuring and looking at ways that you can, from an acquirer standpoint, it's really important to understand what a distressed asset is, and then when you should make that acquisition. So can you share with us a little bit of insight in that?
Yeah, there's a lot of risk and sometimes a lot of reward when you're trying to catch one of these falling knives. There's been great stories of turnaround success, and then there's been obviously sometimes it's better just to kind of stay away. Try to put together shattered glass isn't easy. But if for people that are looking to buy distressed companies. I would say the best way is actually buying assets out of a bankruptcy proceeding, and the reason for that is you get there's a 363 sale process that happens when you buy assets out of a bankruptcy, and the beauty of that is that you get a federal court order saying that these assets are free and clear of all liens, claims, and encumbrances. Okay, so that's super important because you can have a purchase agreement that says that, and that's great, but when you have a federal court order that says that it's much better. But if you're buying them outside of bankruptcy, then you got to be really careful on things like making sure you get payoff letters from lenders. You get language in your documentation saying specifically what assets are included, what assets are excluded, what liabilities are included and which are excluded, and you need to kind of make sure that a seller is going to indemnify you for losses that come up based on what's excluded, because there's this concept in distressed M&A called successor liability, which is where creditors can sometimes come back at you for tax claims, employment claims. You don't want to deal with stuff that you don't want to deal with. So it's super important to kind of know what you're getting into and planning around some of those kind of toxic risks that are out there.
I mean, you've listed quite a few things that I'm sure not everyone knows about. So it's kind of an interesting then when you don't know what you don't know, right? So share with us your insight as to what we just had asked. Restructuring of a company, and then if there's real estate that's involved, how would you go about that?
Yeah, so real estate, you have to remember, comes in different forms, right? We call them the sticks of ownership. Most people think of real estate as you either own it or you don't own it, but there's also real estate rights in a lease. So when you're buying a business, you're either buying real estate that comes with that business, or you're buying a leasehold estate is the technical term for what you would be buying if you were getting into a lease or taking over someone's lease. So if you're going to do that in an acquisition, then you really need to be talking to your attorney about how it is you should be acquiring that. So it really depends on if it's an asset sale or a stock sale, and whether or not you're buying the asset under a different entity than you're running the business, or whether you're going to run it all as one. So there's a lot of considerations to take into account when real estate is involved in a transaction like that.
Yeah, and I'll add that with any type of distressed transactions, you're almost always going to be taking assets and not stock of a company. Now there could be rare situations where I'm not going to get into intricacies, but you might want to take stock in a distressed transaction. Those are far in between, but generally going to be asset sales.
And a lease can be an asset. So if you want the lease, if you want that building that they're using, and you want to step into the place of that lease, they can assign that lease to you. There's a process to that. Yeah.
Very strategic in nature, right? Like you were saying, there's both the service or product of a business, and then that brings in the revenue, and then you have the physical asset that is either leased or owned, which is in essence two different businesses,
right?
Because you could use the real estate in a separate transaction.
Right. Or you might be buying the real estate and only using a portion of it, like some of my clients who are medical doctors who are buying buildings along with it. They might use one space of that building, but they're leasing out to other people the rest of the space. So that could be a whole different income stream that you may or may not have thought about.
Yeah, I've seen that as well, where sometimes buyers will buy a business that includes a real estate only to kind of turn around and flip the real estate, kind of free up cash, get rid of some of that SBA debt or other debt, and then open up that cash to expand. But that typically requires paying off the lender for the proportionate share of the real estate part.
Yeah, I would say there's probably people that just buy the real estate, and then that's all they do, and then just become more of the landlord as opposed to run the business.
I think it definitely depends on what your angle is. Some people will go into, let's just say, car washes, that are operating businesses, but really what they want to focus on is the real estate aspect of it, because you can put a lot of leverage on those, and investors like the security of the real estate and then the cash flow that can come with it. But some people are more focused on just expansion and growth, so they can kind of bundle up to a bunch of different locations, and the real estate becomes too heavy on their balance sheet. So it just kind of depends on what your structure is and how you want to model things.
Yeah, and real estate can also be used as a leverage, like you leverage it, because real estate, the market for borrowing money in real estate is much more defined. So you can leverage that to use the money for whatever you're doing in the business, and then you can also leverage the rentals that you're getting out of the other spaces, or you can leverage the depreciation that you're getting off of the property to
so strategic.
So there's a lot of strategy with real estate.
Talk to us more about team during a transaction. I think it's really important for us all here to know who we need on our team to be able to make that acquisition, or obviously make the sell of our business, go through a good transaction. So share with us a little bit more there.
Yeah, so if I were to, buy a business today, I would first start off with, a lot of times sellers will operate with business brokers, but I would probably want to talk to a buy-side business broker too, to kind of help me find a specific target that I'm looking for. I think, it's important to, and if you don't know what the target is, maybe they can help you define that. From there, a quality of earnings expert, I would say, is be a very important part of my deal team, because I don't have necessarily the background to kind of analyze the financial statements and tax returns and things like that. So I want to make sure where are there going to be cliffs and valleys in cash flow. I want to make sure that the bank statements reconcile with what the seller's reporting, and then so there's not a lot of miscellaneous unreported income that they're saying is there, but is maybe not there, or be taken away. And then, of course, M&A counsel, to kind of help with, diligence aspects, mitigating risk with, the whole structure of the process, and also for planning. With every client that I sit down and talk to, I talk to them about what's your exit going to look like. Well, let's just not talk about this acquisition, but let's talk about 5 years, because there's steps that we can take up front that'll kind of, have huge rewards down the line in your exit, and so what you're planning for. So that's how I would structure a deal if I was buying a business today.
Yeah. I would just add one thing is, and this is not a pitch for high fees, because we're not a high fee firm, but I would just say, knowledge is good. So you definitely want an attorney and a CPA that has the knowledge, and you can always, barter for the fees that they charge. But I would say never, 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 this is going to be like a triple negative probably, never gyp yourself on the accountant and the attorney, because they have strategies that you don't know about that's going to save you way more money than you'll ever spend on that person. So just, I know it's scary, I know it's awful to get that bill, but just understand that that's part of the investment that you're making, and make sure you don't gyp yourself on that stuff.
Yeah, I think it's the time, and transactional attorneys will say it all the time, but that expense that you pay up front, the whole goal is to avoid these $100,000 multiple six-figure litigation landmines that could probably have been prevented if you just kind of taken the right steps to plan ahead of time. So it's super important.
That's so good. We'll take questions here at the end. A few more that I have here. In regards to, we just structured about, hey, I'm about to exit, I'm about to purchase, the team members that are needed, and then let's move into the financial stack. It's important that we have a financial stack to be able to make that acquisition if we're a fund or if we're a business that's starting a fund. Could you share a little bit of wisdom on that, as far as structuring of a fund, and then also placing a capital stack that would make sense for one to be able to acquire?
Yeah, so if I think I understand the question, I think, as far as like raising fund investor capital, I think it depends on your willingness to give up a little bit of control, because that is functionally what you do. You're going to share some of the control, and you're going to share some of the upside. But of course, you can greatly expand your targets with more capital, with that money. But that's something we see regularly with on the real estate side and on the M&A side, where we help founders, acquirers set up search funds, often through 506B, sometimes 506C, where they go through a proper process of soliciting investors, having operating agreements that govern things like control, distributions, allocations, and then that they usually couple that with usually some form of debt. And I think that's kind of the big factor, is like, how much debt are you willing to absorb? If you're willing to take a higher level amount, you may not need to raise that investor capital. And now I think the SBA has changed a lot of the rules on what your capital stack can look like. And so I think it's kind of you got to be mindful of what those rules are if you're trying to take on SBA debt.
Do you have some insight as to the new rules that the SBA has put out?
Yeah, so if you're going to, I think that there was a trend, kind of in the post-COVID, with some of the rate changes that, kind of allowed you, and you've probably maybe you've seen some of these influencers on, social media and whatnot, talking about how you can buy a business for zero money down. And so there was a lot of that, and maybe not coincidentally, there was a spike in defaults among SBA loans, and of course, when you've got tax dollars, that's a big concern. So now they've kind of tightened up on that, and so if you're going to take on seller notes, you still have to put in the 10%, and I'm blanking on the other one right now. The seller notes will often have to be personally guaranteed if they're up to, I think, 20%. So
Okay.
yeah, I mean, they just came into effect earlier this month.
Just recent that happened.
Yeah, just earlier this month. So I'm still
new
going through them myself to making sure I got them all right. But they're not too burdensome that you can't do an acquisition with SBA debt. But there's certainly things to be mindful of.
Yeah, whenever you're talking about government money or government money that's not government money, but money that is guaranteed by the government, there's going to be a lot more hoops to jump through and a lot more underwriting factors. So the more expensive debt, less hoops. The cheap debt, more hoops. That's usually the way it is.
Yep. Yeah. And then typically there, and then I guess depending on what your deal size is, some of these loans are syndicated where you'll have some portion of it. It's often through the same bank that it'll be an SBA portion, and then they'll come in and also do a conventional portion of the loan. If you're trying to, let's say, buy a $10+ million business, there might be an SBA part of it, a non-SBA part of it, and then whatever the rest of your equity is going to look like.
Yeah, I'd like to make tonight a little bit of interaction as well. So what I'm going to do is I'll open the floor again for questions right over here and maybe over here, and then I'll repeat that question so everyone out here and can understand.
I was really going to
Curveball.
I was really going to follow on what Fareed said about everyone who's doing a business, buying a property, they need a team of advisors, right? And I spent several years as public accounting, tax guy. It's so frustrating because I tell my clients, right, before you make a major decision, you meet with your attorney and me at the same time.
Right.
And invariably, they'd call me, hey, I met with my attorney yesterday, and they said. And then I'd listen to what they had to say, and I'm like, well, from a tax perspective, that's a horrible idea.
Right.
Okay.
So you need to invest. If you don't have the money to invest in your wealth manager, your attorney, your CPA, your insurance person, all being together, you shouldn't be doing whatever you're doing. You need all the voices in the room at the same time. Otherwise, you're going to end up spending more money going person to person to person, and then coming back and starting over because someone else said, oh, well, that won't work because of this.
Right.
So get your professional advisors together. Make sure that you create the one page that you need to work from.
Right.
And you can't do that unless you have all the voices in the room from the beginning.
Right. Yeah, a lot of times the attorneys are the executioners of what the CPA and tax attorney or tax advisor gave us. So a lot of times we're executing on what their strategy set up for tax reasons, which, we don't always think about. Not since I had a professor called the tax ninja in law school have I thought about taxes. I usually let the CPAs do it.
Yeah, sometimes it's even less than that. Sometimes it's, hey, here's an LOI. I need to close this, by the way, in 3 days.
Right.
Can you help me? And it's like, okay, well, this is not ideal, but we get those calls pretty regularly, and so you kind of got to be like, well, I hope you've thought about the tax consequences. I hope you've done the financial diligence. I hope you've assessed the legal risks. I hope you've done all this stuff. If you want just a plain purchase agreement, I can do that, but that's definitely not ideal. And there's probably going to be things like
thought about reps and warranties,
Right.
insurance, and if you have
I trust the guy.
talked to reps,
Yeah, it's like don't worry.
Insurance guy.
It's my buddy. It's my buddy from high school. Don't worry, I trust the guy. It's like, okay.
So the wise thing to do would be, one, obviously get a team, make sure that you're all on the same page, almost simultaneously, not jumping to conclusions too quickly to try to get a deal done per se. And I'm sure we could talk about a deal that maybe you have seen that has gone completely awry and why. So share with us a little bit more about that.
Yeah.
A bad deal.
Our clients are all smart. So.
Well, there's going to be one in there.
I've seen a lot of deals go awry, and they're usually not ones that I structured. But it's because they did it themselves. I had about a week ago had an elderly couple come to me. They had sold off their family business. It was $1 million. I can't remember exactly what the industry was, but it was like $1 million business. And it was a stock purchase agreement, okay? And they had used, and if anyone's ever looked at the stock purchase agreement, you guys know that these things typically went pretty long because the reps, the warranties, indemnification, these provisions are pretty lengthy for a lot of reasons because you're transferring not just the assets, but you're also transferring liabilities. Well, unfortunately, it was like a 3-page document, and the buyer they took over some debt. Okay, great. It's not necessarily on the sellers anymore. Unfortunately, the sellers had still a personal guarantee in place that they never got released, and of course the buyer defaults. And what does the bank do? The bank offsets $100,000 that they have sitting in cash in the bank account, and they're still coming after them for another $30,000. Why? Because they didn't take the right steps of actually getting counsel to kind of walk them through. Because if I have a seller that has a personal guarantee on some debt, I'm going to for sure push to get the thing released at closing, or for sure seek indemnification from the buyer on that. But just poor planning, poor execution, and it comes back to elderly couple. The $100,000 makes a huge dent. That $1 million was their life savings.
Yeah.
To lose $100K like that's a huge chunk of their wealth.
Well, it's one thing that I've seen, obviously, working with small business owners just now, right and left. And obviously, we're on this tour, going across the nation, talking to people just like what you're talking about. We want people to be more educated on their exit, but also more educated on their acquisitions, and it can completely be life-changing. And when you have the right team, like what you guys have been able to do, and then also the right people. So we just want to say thank you so much for joining us again here at the Acquisition IQ National Tour, and thank you for sharing your wisdom and knowledge. I'm going to open up the floor. Anybody who have questions? Yes.
2 things. I read about a case in Delaware 2 years ago. The seller paid the buyer $40 million to sell their company. That's backwards, right? Because of indemnification. It wasn't defined right. So maybe Fareed or your colleague could talk about kind of the importance that the business owner understands exactly what's in the purchase agreement. And this was an oversight by seller's counsel, but those could happen. So maybe talk a little bit about the collaboration needed to really make sure that the agreement is right.
Yeah, I think unfortunately, there's so much that goes on with an M&A transaction that the parties probably aren't actually looking at the paper, and it's okay if they're not, but as long as they're being advised on what things mean, and because what the purposes of some of these what reps are, what warranties are, what indemnification provisions are. If you're buying a business, this is your reps and your warranties. These are a couple things. They're one, your risk mitigation strategies. But they're also your playbook for how you're going to operate the business, because you want to know about are the assets functioning, or who are the employees? Do you have employee benefit plans? What are your environmental practices? These are critical aspects that you're going to need to know when you take over the business. And then the teeth to that is your indemnification provisions. Like, how can you take action in case some of those reps are wrong? Because if you have a $100,000 claim coming at you post-closing, and your indemnification provisions are super soft, well then you're gonna have to go sue and spend $100,000 to go collect that $100,000, which no one wants to do, because litigation is costly and it drags out. So there's things you can do to kind of prevent some of these issues up front. On the sell side, these reps and these warranties. On the flip side, these are going to be the teeth that the buyer's going to come back to you to eat away at your earnout, offset your seller note, or potentially assert claims against you. And obviously you want to make sure that you've got the language right, so it adequately captures what you're trying to convey and the risk that you're willing to take on for the reps. Because as a buyer's attorney, I'm going to on one hand I have to balance zealously advocating for my client, but also getting the deal done. But when I know that I'm going to have an easy opportunity to get slam dunks, I'm throwing very aggressive reps at the seller, especially if I sense there's any type of distress going on. And if you're the seller, then you're going to want to make sure it's like, hey, do I really want to make that type of promise? Because this could come back and hurt me on the back end.
Can I be greedy and ask one more question?
Absolutely. I'll repeat your question.
Talk a little bit about incentive-based equity on the transition and keeping invested after the purchase. And quick note, everyone should follow Fareed and his MW colleagues on LinkedIn. Free legal advice. I learn something new every time I read a post. That's it.
I appreciate that. I'm signing autographs later, so I got you, man.
So repeat,
I appreciate that.
repeat that question. Do you remember?
So I think the question was on incentivizing sellers, post transactions, and so I think that can be tricky. I think it depends on the nature of your seller. If it's someone that's later in life and they're looking to retire, I think it's going to be hard to incentivize them to kind of, unless they've got alternative reasons they want to make sure the success of the employees, things like that. But I think for those it needs to be really monetary. It's things like earnouts if you can get them if they're not SBA loans. Things like your seller notes if you're going to employ them. Post closing, if they're not necessarily looking to retire or have health issues, I think you can structure employment agreements to kind of really incentivize them, which giving them equity, giving them bonuses, different things like that to kind of help them successfully transition the business, under your ownership.
Yep.
I have a thought on that, if you don't mind. Earnouts are very tricky. And I think it depends on who it is that's creating the earnout to determine whether or not someone should ever take it. I won't name names, but you just have to be careful on the earnout thing. If you want an owner to stick around and transfer those relationships, then you need to build a relationship with that owner so that they understand that by continuing to work with you, and I would suggest you just pay them as opposed to an earnout, then you want to create a relationship to help them understand why them staying to work with you is going to benefit their employees and their customers, right? Earnouts are tricky. Plenty of examples about earnouts are designed so that the previous owner never makes a dime.
Right.
You just have to be really careful with that. To me, it's create a relationship with the existing owner, find out what's important to them, and then work on what's important to them to get their continued support and help.
Especially these founders, it's a pride to know it.
Yeah, I think lawyers may not be saying these types of statements, but I think it's so true and so valuable. I think it's those relationships. I think not just for the transition, but also for I'm sorry, I forgot the gentleman's name with the distillery.
Don.
I think if you're trying to buy it, he mentioned what he's looking for in someone that's looking to buy his business, but I don't think he's selling to some New York private equity shop. I think he's looking for someone that's going to carry on the legacy that he's trying to build here.
Yep.
And so I think then you do that having a relationship with a seller like that is not just about the go forward plans, but also actually get them to engage with you on entertaining your offer to buy his business.
Vision.
Yeah.
The vision. Yeah.
Yeah, that's awesome.
Continuing the existing owner's vision.
Yeah, it's very important. Making sure the employees aren't going to get terminated on day one.
And by the way, if the current owner's vision is flawed, you have to be well versed enough to be able to explain why you think it's flawed and get them to understand where you want to take it. Because if you can do that, they'll buy in even stronger.
Yeah.
Going off your point, when you said about CPA and keeping the attorneys, it does help when they both know each other and they've worked before.
Yeah.
In our case, that was very helpful. And we did the last transaction with about $8 million.
Yeah.
And it took us, 6 or 7 months, and we had to actually engage trial attorneys because we had difficult sellers.
Yeah, we did.
And
We had to force the deal a
difficult
little bit.
suppliers, and we had to knock out a lot of personal reviews, and Pete got us through the whole process. And when the trial attorneys came in, we're like still counting on Pete to hold us through that also.
Yeah.
Kind of like you lawyers talk.
To mitigate the
So it was more like I'm just listening. You lawyers talk. And I have to pipe it, I'll pipe it. But
Yeah.
they helped us through the whole transaction, and in the end, it's been very, very, very helpful. So thank you very much for that.
Yeah, and in case you didn't know, litigators and transaction attorneys do not think alike. So if you have to have a litigator, you definitely want to have your transaction guy kind of tempering the litigator a little bit.
Oh, yeah.
That's smart. One last question, right over there.
I was just going to ask, do you guys service nationwide in all 50 states?
Yeah, because we're doing transactional work, all our clients are buying and selling real estate and businesses across the country.
Awesome. Well, let's give them a quick round of applause. Thank you so much for joining us.